The process by which the banking system creates money from an initial transaction is known as the fractional reserve banking system. Here's how it works, step by step, with a single transaction acting as the starting point for the creation of more money. 1. Initial deposit. Let's say you deposit $1,000 in a bank. The bank is required to keep only a fraction of that deposit as reserves, as determined by the reserve requirement ratio set by the Federal Reserve. For simplicity, let's assume the reserve requirement is 10%. Reserves. The bank must keep $100, 10% of $1,000, in reserve. Excess reserves. The remaining $900 can be loaned out by the bank to others. 2. Lending the excess reserves. The bank loans $900 to another customer, which is now new money in the economy, even though the original $1,000 is still in your account. This loan might be used to buy something, and the seller deposits that $900 in their bank account. The banking system now has $1,900 in deposits. Your original, $1,000, and the seller's $900. 3. Second round of deposits. When the $900 is deposited in another bank, that bank also keeps 10%, $90, as reserves and lends out the remaining $810. Deposits, $900 deposited by the seller. Reserves, $90. Excess reserves available for loans, $800. Continued lending. The process continues as each successive bank lends out 90% of the deposits it receives. So, after each round, a portion of the deposits are kept as reserves, and the rest is lent out, creating new deposits in the economy. The following sequence occurs. Banker loans out $900 from the initial $1,000 deposit. Deposits increase by $900. Bank B loans out $810, 90% of $900, and deposits increase again. Bank C loans out $729, 90% of $810. Money multiplier effect. This process keeps repeating until there are no more excess reserves to lend. The total amount of money created through this process is determined by the money multiplier, which is the inverse of the reserve requirement ratio. The banking system can create up to $10,000 in total deposits, including the original deposit. Conclusion. The key takeaway is that banks create money by lending out a portion of the deposits they receive, while keeping only a fraction as reserves. This process is repeated across the banking system, multiplying the amount of money in the economy as each round of lending generates new deposits. This system is detailed in Modern Money Mechanics, where the mechanics of bank reserves, deposit expansion, and the money creation process are described in detail.